Welcome to our next reading on inventories. So we're talking about our raw materials, our finished goods and our work in progress. Okay, so if we were looking at a basic company, a merchandising company that simply bought in goods and sold them, then our inventory equations would be beginning inventories plus purchases being the available for sale goods minus cost of goods sold, representing the goods we've actually sold, equals our ending inventory. Or as we see it in the income statement, beginning inventory plus purchases, the available for sale, subtract what we haven't yet sold or sold, the ending inventory, and that gives us our cost of goods sold. Now, why are we applying this? We're applying it because we're applying the matching concept, one of our accruals concept. What we want to make sure is that our cost of sales, otherwise known as cost of goods sold, matches the number of units we've actually physically sold. So we take our beginning inventory, add on the purchases that we've made in the year, that gives us the total number of units available for sale. If we haven't sold all of those, we're then going to subtract the ending inventory. We're taking this ending inventory out of our income statement and storing it in current assets in the balance sheet because we're saying these haven't been sold yet, they shouldn't be in the income statement. And that will take us down to our cost of goods sold or our cost of sales, representing the cost of the units that we actually physically have sold. So we're trying to match the cost of goods sold to the number of units actually sold. Okay, our first little LOS asks us to distinguish between costs included in inventory and costs recognized as expense. Now you can see product costs are capitalized as inventory. The basic rule here is we can include all of the costs in getting our inventory into its current location and condition. So we'll include the purchase cost of any materials, less any discounts and rebates that we receive, the conversion cost of converting our materials into goods, so labor and manufacturing overheads, and any other cost necessary to bring the inventory to its present location. So all costs involved in bringing the inventory to its current condition and current location can be included in our inventory figure. Now, period costs are ones that are going to hit the income statement rather than being included in inventory. Abnormal waste. So in other words, when we look at our material and our labor, it should be based on the standard cost of production. Any overruns are deemed to be abnormal and should be expensed. Storage costs. Well, storage of our finished goods. Again, storage of our finished goods wouldn't be included. It would be in our sales, general and admin because our cost of goods sold should only include the cost of manufacturing, producing your goods, essentially not storing them. Okay. So storage costs wouldn't be included unless they were required production costs. And then finally, selling and administrative costs, of course, again, have nothing to do with getting your goods into their finished state, so again would be expensed. Let's have a little look at an example. So in our particular company, we've produced 1,500 units. We've incurred $10 million worth of cost on raw material. Our labor costs $5.3 million. The manufacturing overhead for the year, $2.7 million. Freight into plant, cost of getting the materials into our warehouse, $150,000. Storage cost of finished goods, $375,000. Abnormal waste on material overruns, $200,000. And then some administration costs here of $190,000. So what we've been asked to do here is to work out the standard cost of one unit. So what we're going to do is take our materials, because of course they're involved in getting the stock into its current location and condition. Labor cost, because of course that's involved in producing our finished goods. The manufacturing overhead, and notice labor cost and manufacturing overhead we refer to as our conversion costs. So as long as they're the standardized amounts and don't include any overruns, then they can be included. Now remember, we can include any costs of getting our inventory into its current location and condition. So any freight in, any cost of receiving the materials into your plant can be included. Now notice the cost that we've excluded. We've excluded the storage cost of finished goods. No, it's only the cost of getting your goods into the current condition and location. Any further storage costs are excluded, so we won't include the $375,000. Abnormal wastage. Again, no, we should only be including the standard cost of producing our inventory, so therefore the abnormal cost is ignored. And administrative costs, no. Our manufacturing overhead would include all of the overheads related to production, such as the electricity for the machines, the depreciation of machines, etc. Okay. Any administration overheads, anything to do with the daily running of the business but not directly related to production, cannot be included. So if we add up our costs, 10 million, 5.3 million, 2.7 million and 150,000, we get a total cost of our inventory of 18.15 million. Divide that through by the number of units you've actually produced in the year, 1.5 million, and we get our standard cost per unit to be $12.10. Now our next LOS asks us to describe the methods of valuing our ending inventory. What it's asking us to do here is describe the cost formula. And essentially there are going to be three major methods we could use: FIFO, LIFO and average cost. And we use those to compute cost of goods sold and ending inventory. Just note that again there is a little video here in the Swayzer library covering FIFO, LIFO and average cost for you. Okay, so here are four major methods. Okay, so there's an extra method here called specific identification. Let's start off with FIFO. First in, first out is what FIFO stands for. The first goods that entered your warehouse were the first goods that you sold. In other words, it's assuming that you've sold the oldest items first, and as a result your ending inventory must contain the most recent purchases. And assuming that we live in an inflationary world, those most recent purchases will be at higher prices, so under FIFO we'll get the highest ending inventory figure. Now conversely, if ending inventory contains the most recent purchases, cost of goods sold must contain the older purchases, and in an inflationary world therefore they'll be at lower figure, so you'll get a lower cost of goods sold figure. LIFO. Now notice it says no IFRS, so LIFO is prohibited under international accounting standards. LIFO stands for last in, first out. Basic idea here is the last goods that entered our warehouse were the first that we sold. In other words, we've sold the most recent purchases first, and as a result our ending inventory must be made up of the oldest purchases. So in an inflationary world, if our ending inventory is made up of the oldest purchases, that must mean it contains the lowest purchases, the lowest purchase prices, and as a result we'll get the lowest ending inventory under LIFO. However, if we've sold the most recent purchases at higher prices, it means our cost of goods sold will be higher. Now AVCO, or average cost, says I've got no idea whether I've sold old or new items, they all look the same, so what we're going to try and do is work out a standard cost, if you like. What we do is we take our receiving raw materials and selling finished goods, and our gross profit margin, gross profit over revenue, where gross profit essentially, and revenue they mean sales really, is sales minus your costs of goods sold. Okay, inventory management, in other words, warning signs and things that the analyst should be looking for. So they say, well, what about low inventory turnover? So the days of inventory on hand is very, very high. Now, if days of inventory are very, very high, it could indicate that you are having problems selling your ending inventory. And if you're having problems selling your ending inventory, it could indicate that you have obsolete inventory, in which case the analyst would be making sure that that inventory has been written down. High turnover, low days of inventory on hand with low sales growth relative to the industry. Now essentially, if you've got low sales growth but very small days of inventory on hand relative to the industry, it could actually indicate that you're losing sales from insufficient inventory levels. And we talk about losing sales from insufficient inventory levels as being stockouts. Okay, so your sales growth is low relative to the industry, but you're turning your inventory over very rapidly, so you've got very little inventory on hand, meaning essentially people might come and want to purchase from you, but you haven't got the inventory. High turnover, low days of inventory on hand, okay, with sales growth that is above industry average. Well, that would, of course, indicate efficient inventory management. We're making high sales, and our sales are growing at a very rapid rate, but we've got low days of inventory on hand, meaning we're holding the minimum amount of inventory that we require, so we're being very efficient. Okay, let's finish this reading with a question. For analytical purposes, an analyst would prefer to use which method? LIFO COGS, FIFO inventory? Well, remember, basically, they like LIFO in the income statement because the cost of goods sold would represent the most recent purchases, but they prefer FIFO in the balance sheet because FIFO in the balance sheet, the ending inventory would contain the most recent purchases. So therefore, our answer is A.